Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at STNG, or Scorpio Tankers, Inc. STNG is a provider of marine transportation of petroleum products worldwide. Here's the barchart.com technical opinion rating for STNG. The bar chart rating is an 88% buy, with the strongest short-term outlook on maintaining the current direction. The market is in highly overbought territory. Beware of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that STNG is above the moving average line, so the monthly trend in STNG is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The chart shows that the blue line is above the green line, so the daily trend in STNG is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. STNG is below the upper Keltner channel line, so STNG is inside the buy zone. Since the trend is up, we want to buy a call. STNG has plenty of option chains to choose from. We're going to use the December 15 option chain. Right now, the December 15 options have 41 days to expiration. Here's the STNG option chain for Dec 15. STNG closed at 58.55 on Friday. That means any calls on the list from 30 to 57.5 are in the money. Let's take a look at the profit potential for purchasing the STNG December 15 57.5 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 57.5 call is 390 to 410. We try to enter at the midpoint, so we'll use 4 even as the buy price. Our call option calculator shows the profit potential for this call based on STNG price changes at option expiration from flat to a 12.5% increase in price. We can see that if the STNG stock price is flat at 58.55 at option expiration, the 57.5 call will lose 73.8% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 50 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 50 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the Sting stock price is up 1%, the 50 call will lose 1.8% of its value. We want that to be break even or better, so the 50 call does not meet our requirements. Let's see if the 45 call will work. The bid-ask spread for the 45 call is 13.10 to 14. We try to enter at the midpoint, so we'll use 13.55 as the buy price. The 45 call works. If the Sting stock price is up 1%, the 45 call will make a 4.3% or $59 profit. That's better than break even, so the 45 call is the one we'll buy. The call option purchase calculator also shows that if the Sting stock price increases by 2.5%, the 45 call will make a 10.8% or $146 profit. If the Sting stock price increases by 5%, the 45 call will make a 21.6% or $293 profit. If the Sting stock price increases by 7.5%, the 45 call will make a 32.4% or $439 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the STNG stock price does not make the expected move up, it remains flat at expiration, the 45 call would break even, no loss, compared to the minus 73.8% or minus $295 loss for the 57.5 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the Sting D's 15 50 strike call and sell to open the Sting D's 15 55 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 50 call for $9.30 and sell the 55 call for $5.55. $9.30 minus $5.55 equals $3.75. So the entry price or debit cost for the spread is $375. The call option spread analysis calculator picture shows that the spread will make a 33.3% or $125 profit if the Sting stock price declines by 5%, remains flat, or increases in price when the options expire. If Sting is down 7.5% at expiration, the trade will still make 10.9% or $41. Creating the debit spread will allow us to collect a $555 cash credit to our brokerage account for the sale of the 55 call. As we said on the previous slide, this reduces the cost of entering the spread to $710. I'm sorry, to $375. Here's a note regarding earnings reports. The next Sting earnings report is scheduled for this Thursday, November 9th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the Sting D's 15 45 strike call for $13.55. We also reviewed a spread. The spread said to buy to open the Sting December 15 50 strike call and sell to open the Sting December 15 55 strike call at a debit of $3.75. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.